Hey folks, Dan Frio here, and today we're talking about being prepared. I won't say for home buying, I'll just be saying being prepared to apply for a mortgage. And we're going to talk about the 3 C's that are involved in that. And when I was doing my research, I came across an article right through here, and this was kind of scary. It was 2009, and it says the 3 C's of getting a mortgage. And we're gonna read some captions in here because this will give you some insight of what was happening back in 2009. Remember I say about the housing crash and what caused it? We're going to talk about that. But the main topics we're going to talk about in today's video is your credit, what credit systems do the credit agencies or the mortgage companies use, and how do you get those? That's one of the biggest things, because a lot of people when I talk to on a daily basis, they're like, okay, my credit score is 680. And I'm like, how do you know that? And they're like, this is my Discover bill. So I'm going to show you where you can get your true credit score that mortgage lenders use. And then we're going to look at capacity. What does that mean, and how do we capture that? So that really means, what is your debt ratio? We're going to go over your budget and explain to you what is part of your debt ratio and which mortgage programs you're going to qualify with or for, depending on your debt ratio. And then the last but not least, the collateral, the house. We're going to talk about different programs with that, and then we're also going to talk about the varieties or different variations of appraisals that are done. There's a different appraisal if you're buying a home using an FHA program or a VA program or a USDA program, as well as a conventional loan. So those are the topics we're going to talk about in today's video. If you got any questions along the way, please feel free to ask those. But without further ado, let's get to it. We had a nice day today with mortgage rates. They're down a little bit, 6.87. When these hit about 6.5%, you're going to see a flood in the market of people refinancing and people starting to buy. If this rate gets to 6 or in the 5s, you'll see the housing market come back. I can almost guarantee you that, as well as we're going to see a lot of people refinance. So let's get you prepared for this. So let's start breaking this down. Your credit scores. What do you need to know about them? Well, let's get over to here. I actually created this in a Word document, because I want to go over these things with you. So let's get over to your credit scores and the different credit scores out there. The first one we want to go through is credit. What is your credit score and why it matters? Credit score ranges, what affects your credit score, how to improve it, and so forth. And the reason, one of the biggest topics, or a big piece of information you can get on this, check out my YouTube channel. I have a ton of videos talking about credit and credit scores, and one of them is right through here. If you go to creditscoresandmore.com, I actually created this website probably about 10 years ago, and it was just for this purpose. I did a video. I'll show you that video. Let's scroll down between here. This video was one of the first videos that I did, and I posted, and it got about 250,000 clicks pretty darn quick. So I was like, okay, I think a lot of people are confused on credit scores. So let's go down through those with you. So that was also the reason, or the creation of Credit Scores and More, why it was created. So let's first off look at credit scores. Okay, if you guys have any questions in regards to this, feel free to ask. But we're going to go over that. What credit scores are used? So if you go down through this on my website, you're going to get a variations of, and the reason for this is this might be updated in some areas, but you're going to see a lot of things here saying FICO, 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 FICO. Everything's going to say FICO. Well, when you're getting your credit score, make sure you're getting your FICO score, and I'm going to show you on Credit Scores and More where you can get it at a discount. Yes, it is an affiliate link, and I do make a couple dollars if you order this, and it just helps support the channel. But the whole purpose of this is right through here. So what I want to show you guys is this. Okay, what FICO score is actually used? So I went down through here and I did a chat GPT, and here's what it gives us. The FICO models used for your mortgage loans are this. The Experian uses FICO 2, Equifax uses FICO 5, and TransUnion uses FICO 4. So we go over through, here's all the variations. Now look at all the numbers here. You got FICO Auto Score 2, Auto Score 8, Score 8, Banks Card Score 2. You probably have over 30 different credit scores, and I'll explain them briefly for you. There's a lot of systems when you're getting your free credit score. In most cases, what you're being provided is your Vantage credit score. There's no lenders that use that credit score. It's basically a model or a simulator that just helps you monitor your credit and credit scores. It's a free system. I think TransUnion or Equifax created the system as a free version to the consumer because a lot of people don't want to pay for their credit scores. So, but if you want to really truly find out your credit scores that your home company or your home loan is going to use, or even your car company is going to use, you have to really pay attention what model they're using. So it gets a little confusing. There's a ton of different FICO programs, but let me explain it to you this way. there's 3 repositories. There's Equifax, Experian, and TransUnion. These are the 3 different repositories. Okay, so that's those companies up there. So what they each have is each one of these models. For example, let's just go with Experian. They're going to have a couple different categories when it comes to credit scores. They're probably going to have 4 subcategories. Okay, one is going to be your auto score, which you're seeing right through here, your auto score. One's going to be a credit card score right through here, bank score. One's going to be an insurance score, and one's going to be a mortgage score. Okay, so you have a bunch of, so this is just in this model. So let's assume Experian, they have 4 classes. A is auto, B is credit cards, C is insurance, and D is mortgages. Okay, now each one of those models has a different subsection. So this one FICO score, this could be a FICO score 8 for your mortgage score. There could be a FICO 2, a FICO. So each subcategory also has 3, 4, 5 different models, and that's why you're seeing the submodel 8, 2, 3, and 4, and all that other stuff. So you take this one that has 4 subcategories, and each one of those subcategories has 4 more. So you can see there's 16 basically just in this. Then you're going to have probably 12 or 16 over here, and maybe 12 or 16 over here. That's how you're going to get so many credit scores. But if you really want to figure out what credit score you need, well, you go to creditscoresandmore.com. Like I said, where's my website? Right through here, and here's what this system does. And you don't have to use this system. I'm just understand the credit. So I created this site. There's some free systems in here you can use and up at the time, but when it comes back, I'm going to show you me Credit Karma, things like that. If you don't know what I'm talking about, go to creditscoresandmore.com and hit its free score credit score systems. It's good enough for you to use. I use Credit Karma and Credit Sesame, so if you click this, it's going to take you to one of these. I kind of alter around just because you might have heard of one and use one and not the other. So set up with this system. It's free. It gives you very informative information, updates on a lot of different things. I use, when I'm monitoring my credit and so forth, I use a system called Smart Credit. I think it's down in here too. You can go down through here. It's right through here. So this is a system I use. Back in 2008, 9, and 10, it was a struggle in this business, and it was a struggle paying a lot of bills. I'll admit that. So I started using this system to let me know when to pay, how much to pay, how to organize my payments, and it did a fantastic job. So that's why I promoted them on here, and you can go through here and just hit here, manage your credit scores. You can go there right through there. So that's the credit scoring system, and hopefully you can get a little more reference on that. So you can, if you need to improve your credit, you might be able to even add your rent to your credit reports, and I have other things up here to help you navigate that as well. So hopefully the confusion now of the credit scores are kind of a thing of the past, because you need to make sure you're getting your FICO credit score, and this is why I say your true credit score. And if you use this system, like I said, you get a discount, but I do make a little bit of money on that, so it is what it is, and so that's that part of it. So that's the C part of on the credit part of this. Okay, so the first thing we want to do is go over credit. Now let's get over to what kind of programs, what credit scores do you need for various programs. Well, let's get back over to my cheat sheets, and I'll bring those on the screen right now. I should have just added a secondary screen, but my apologies on this. Let's get over to it. So we go down through here, mortgage, and that's not it. Let's go over to 3 C's right through here. So here's the credit scores that are needed for each individual loan class. And I'll debunk these or give them a thumbs up or whatever. So if you're looking for a home loan, and we're going to dissect all these today. We're going to dissect what your credit scores need to be, what loan to value, or basically how much money you would need to put down in these programs, and also what your debt ratio is, the capacity that you have to make mortgage payments. But right through here, this is going to give you the minimum credit scores for each one of these classes. So FHA, it will go down to a 500 credit score. So if you have a 500 credit score down in that area, you might have a tough time getting approved. But if you can get approved, you're going to need at least 10% down because below a 580 credit score, you need 10% down just because of the risk factor. If you have a 580 credit score or higher, you can get away with 3.5% of a down payment, even if you're looking to buy a single family home all the way up to a 4-unit building. So imagine buying a multiplex, a 2 or 3plex, only putting down 3.5%. Well, you can do that with an FHA loan. On the VA loan, well, they really have no official minimum score, but you can't really have bad credit or real bad credit to get a VA loan. So you normally need about a 580 to 620 credit score if it's good, but just for reasons your credit scores are lower, you still might have a good chance of getting pre-approved. You just might have some excess debts or just something that just hit you recently that might be affecting that. USDA usually requires a little bit higher credit score, up 620, 640 range, and then with conventional loans, the normal mortgage you think about, you need a 620 credit score to go there as well. Okay, so that's that part of that equation. That's telling us the credit. Well, let's just continue with this, so then I can just go line by line to make it a little bit simpler for you. Now let's go over the down payment piece of this. Okay, so FHA only requires a 3.5% of a down payment, just like I stated before. The same thing holds true with VA. You could buy, well, VA, you don't need any money down, and you can buy up to a 4-unit property. Think you can buy a 2-unit, 3-unit, up to a 4-unit property with no money down. There is no other program that allows this in there. USDA, you have to have basically a single family or a 2plex, and it is 0 down as well. If you are a first-time homebuyer with a conventional loan, you can also get away with 3% down. But a lot of people, if you have your credit challenged in some of these areas, you're looking to go FHA. If you have really good credit and you're looking to just buy a single family home, go with the conventional. But if you're looking at 2, 3, or 4 units, one of these other programs might be what you're looking for there. Okay, so that's that part of it. So now we're going to go over to another part that we call, and we'll get down to here, the capacity. Now, what does the capacity mean? Capacity, you need to prove that you can repay the loan. Okay, so this is where we get back into the back in the heydays. So let's scroll down here. This website did mention, and again, remember folks, this was 2009. All right, it goes down through here and says this: over the past 10 years or so, the mortgage industry became increasingly complex in terms of banks selling multiple mortgages as packages to investors. Okay, this is where it gets there. This fueled the rise in what we call funky mortgages, such as adjustable rate mortgages. That's not the funky part. What these were is interest only that will allow the borrower to pay much, much more or buy much, much more than they can afford. Many times, you didn't even have to make the interest-only payment. It was basically a pick your payment on whatever you could afford for the first year or two. And then when a lot of these start to adjust, it just blew up in everybody's face. So that's what really happened during those times. So now we get to the capacity. How much do you have the ability to pay? And when we're focusing in on this, basically, well, let's just read what it says. You need to prove that you can afford the loan. Some mortgage brokers and lenders of the past 10 years were signing up buyers for loans without asking for any proof of income. There's that point I was telling you guys. Now you must prove sufficient income and a low debt to income ratio, meaning not only does your income need to be good, but you need to carry little debt. So let me explain what the collateral capacity is. It's basically your budget, your debt ratio. So to go over that, I created another spreadsheet. So I want you to understand the pieces of the puzzle that's involved in these things. So let's go back over to this. And, I don't even know if I did a snapshot for that. I did it earlier, but then I took it away. So let's go back to this complex over here. So what I want you to understand is how to calculate your debt ratio. Okay, what your debt ratio is it's basically you take your monthly income, your gross income, before taxes and the government takes all their stuff, and even before your 401k and all that. So that's your income. All right, so then what you need to do is, based on your FICO credit report, you're going to take all the debts that show up on there, and then any legally obligated debts you're required to pay, like alimony, child support, things like that. You don't include like your cable bill, your phone bill, and things like that. That's not a part of this equation. Basically, it's looking at all your creditors. Okay, so you take all your creditors and you add up their monthly minimum payment, not what you pay, but the minimum monthly payment. Okay, so now you have that component. And now you have to add into that your proposed mortgage payment, what it's going to be either if you're looking to buy or looking to refinance. Okay, so now that's all your debt. Then you divide that number by your gross monthly income. So let's say, I'll just make it simple. You make $2 a month and you spend $1 a month. So you go 1 divided by 2 equals 50%. So that's how you compound or you calculate this. I think it might have a tool down here to help us with that, but I won't go down there. It's the easiest way to calculate that. Just take your pay stubs, but you want to use your gross income, and you also want to use all the creditors on your credit report, their minimum payments. So now what that comes up with, it'll give us what we call a debt ratio. Okay, so now let's go back and let's figure out what program you would fit into if your debt ratio hits certain levels. Okay, so let's get over to this piece right here. So this is, sometimes the data is wrong because I do a lot of chat GPT and AI for this, but here's the data that it compiled. There was one piece that's wrong in here, and I'm going to go through here and give you the snapshot as well. But this is also what causes many people to go with a different program than you anticipated going out with. You might say, okay, I got a great credit score, but your debt ratio is just a little too high. So you might want to go with an FHA loan instead of a conventional loan. So let's go over these criteria. FHA loans, you can get away with a 50% debt ratio. Actually, you can get away with a 57% debt ratio, as long as your front-end ratio is 47% or lower. So let's backtrack just a tad so you can understand this piece. Your front-end debt ratio, so we've broken down how much your gross income is on your debt ratio calculation, so we got that. So there's going to be two components to this. There's what's called the front-end ratio and then what's called the back-end ratio. The front-end ratio is basically your mortgage payment only divided by your income. Okay, in an FHA loan, that can go to 47%. Now, the back-end ratio is what's going to help these borrowers, but not conventional loans. So now the back end is this. It's your mortgage payment plus all the other debt that you might have divided by your gross monthly income. So that's where this comes into play. So this is giving us the back-end ratio. So now you understand the front-end ratio and the back-end ratio. Okay, so FHA, they will go to 57% on the back end as long as the front end's 47%. VA, they're going to go much more than this. I've seen VA loans approved up to a 65 debt ratio. So some people we put into that. Is it a good idea? Folks, this is underwritten by the VA, so they have their modules and they understand the risk factors in those, and they have a lot of other parameters that they factor into that as well. But people can get approved even with up to 60, maybe 65% debt ratio. I wouldn't suggest that what you do, but it is possible. Then you go to USDA. Now, USDA, it was the rage about a year or two ago because everybody saw that you could do 100% financing, and they're like, okay, I need a USDA loan. They're really hard to qualify. You have to meet certain restrictions when it comes to the house. Where is it? Is it in a USDA zoned area? Is your income sufficient for USDA? Can't be too much, can't be too low. What is your debt ratio? All these other things play a component in that. And then the appraisals get pretty tough as well. So that's what we're seeing right through there. We go back through here and we went through the minimum down payments and then the 3 C's. So let's go back to this. Okay, so now we've pretty much captured the capacity and the credit. So again, credit, you know how to figure out your credit, where to get it, creditscoresandmore.com. You're looking at the numbers. The higher that number on your credit scores, the better. But the capacity, the debt ratio is also something that puts people in another mortgage category sometimes. Okay, so now the collateral. Okay, the collateral. Let's see. This was, again, 2009, so I didn't read this fully when I was preparing for this. You need to put down 20%. Piggyback loans became popular, basically folding in a HELOC into your main mortgage to pay for your down payment, as well as no money down for a mortgage. Very dangerous when the market goes down. That's exactly what happened. So you can get a first mortgage at 80%, do a piggyback loan for 20%, no income, no assets, and you can close on that loan, buy it, and then a year or two, these blew up in everybody's faces. So now the collateral comes into play. What kind of collateral are you looking at? What can you qualify for with different types of loans? And what kind of inspections are done? Because you hear a lot that FHA appraisals are tough, VA appraisals are tough. So let's talk about those as well. So let's get over to the collateral piece of this. So again, we can look at how much money you need as a down payment. And I just want to go through that with you one last time, minimum down. So again, When you're getting an FHA loan, you can put 3.5% down all the way down to a 580 credit score. I don't care if you're buying a single family, a 2-unit, a 3-unit, or a 4-unit. Same thing with VA. USDA is a little bit tighter, and they won't. I'm pretty sure they won't do a 2-unit, 3-unit, or 4-unit because it has to be just your primary home. Conventional's 3% down. So these are the LTVs and basically how much you would need to put down. Okay, so here's how we structure it a lot of times. Then I'm going to start talking about how stringent the FHA guidelines are. A lot of people want to go with a conventional loan. Why? It's the easiest loan when it comes to appraisals. Okay, and the reason for that is conventional loans are usually serviced by banks and things like that. FHA, VA, and USDA, those are basically overseen or guaranteed by the federal government. So conventional loans, I won't say they don't care about the house, but they basically want to know the values there, and that the house isn't, a piece of junk, and it's not a safety hazard or anything else. So as long as the value's there, there's nothing really wrong with the house, you'll be okay. Now here's the problem. When you get to these other programs, the appraisals get really tight. No, I'll be honest, they do. For example, FHA, VA, and probably USDA as well, if you have a cracked window, appraisal ain't passing. If you have peeling paint, it ain't passing. If it has mold, you ain't passing. If you have cracks in the foundation, if you have rotted wood on the outside, even if it's on a pillar, you might have problems. So that's why a lot of people choose, they're like, I'd rather go with a conventional loan because I don't want all these uncertainties with FHA. Well, unfortunately, sometimes FHA might be the only way to go because conventional loans are fantastic if you have a credit score in the 700s. And also if you're putting down a lot of money. But where it really falters is when you have credit, I guess credit issues. Maybe you have a credit score of 640, 620, and you do qualify for some of these other programs, the rates are going to be terrible. Okay, because again, conventional loans, they're basically just funded by banks. They want just the loan. Where these other loans, they're government sponsored. They want to make sure that there is due diligence put in on these underwritings to make sure they make sense and the default risk is low, especially when you start getting credit qualities down, in the 580 range and so forth. But these are guaranteed by the federal government, so banks will go out there and take a little more risk on these. Thus, you're going to get a little bit better rates and what we call PMI if you're looking to buy a house with minimum down. So that's really a lot of the factors behind some of these things that we wanted to talk about when it comes to the 3 C's. So if you guys got any questions, we got Kevin here. And if you guys have any other questions you want to go over, please let me know. I'm going to go over the appraisal process here in 1 second. So let's get it. Good afternoon from Lakeland, Florida. Let me know. We actually have a lot of people on here today. If you guys could just let me know where you're coming from, just abbreviate the state if you don't mind. Give me a thumbs up if my vocals or audio is good and my visuals. I'm actually working out of my house today, and the signal might be a little bit lapsed at this time. So just want to make sure you guys are seeing me there. So let's get back to this. So now we went through the collateral and no more using your house for a piggy bank. So we'll continue on, and this is probably a great find for me because I was just going through and I Google searched, the 3 C's of getting a mortgage, and this is what popped up. And when the time frame come up, I'm like, oh, pretty interesting. It's 2009. Okay, was there Rule 1? Let me see if we got a Rule 1 up here. There is one. Wanted. New rule number 1, the old-fashioned 3 C's lenders used to require when following C's as a standard of purchasing mortgage. They are back in vogue, and the reason why is because all these shitty mortgages are gone. Let's see, number 2. What is rule number 2? No more using your piggy bank, your house as a piggy bank. That's where people were coming in. I don't know if you realize, back in 2006-07, you can get a home equity loan up to 125% of your home's value, a home equity loan. Think about that. You would never, I didn't do them because I refused to do them. I'm like, this is the worst loan that I've ever seen in my life. Because if home prices just tick a little bit or flatlined, you're going to be underwater, so you had no money down. You bought the house, then you did 125% HELOC. You're asking for disaster. So that's what we saw through there. So a lot of people were using it as a piggy bank, just keep churning and churning and spending money like crazy and churning and churning. It's gone now, folks. And that's one of the reasons why, I was hoping the refi market would pick up for people getting lower rates, but not cashing out to pay off all the debt that's out there. But there is substantial amounts of debt out there. No more buying too much of a house. Well, a lot of these people got into these adjustable rate, interest only, whatever loans, and they were just buying too much of a house. Because when everything reset, I would sit there and scratch my head on some of the numbers I would look at when I used to underwrite. I'm like, when this thing resets, I don't know what this person makes, but I can kind of have an idea what they're going to make. They ain't even going to come close to being able to afford how much this payment's going to be. Then when you start adding in, your taxes, your insurance, and everything else, they were just bad. And I saw that coming. See if there's any other rules for us. So that was basically the rules there. So let's get some of your questions out there that you might have. I accepted the short sale bank counter offer. What happened now is how long will it take to get the package back? I accepted the short sale bank counter offer. So you actually put in for a short sale. That's interesting. I would love to, Joel. I would love to talk to you offline possibly and just understand, what happened. Because every day I come on here and, I tell people, you can't really go into foreclosure or things like that because I can't see how you can possibly be underwater. So I'd love to know your story. I'm not going to ask you to put it here online because that's not courteous and that's not professional, but if you wouldn't mind emailing me or don't put it up here, just Google search me or down in the description below you'll see our number. Please give me a call. I'd love to just understand what happened in your situation. I might even have some ideas for you, but I can give you, in the past, the short sales, they took forever. They would take 6, 8, 12 months to go through, and everybody just finally stopped even going through with them. So good luck with that, but if you wouldn't mind, I'd love to talk to you. The next piece, everything sounds great to me. A question to you, lock today or wait until Friday, closing on the 24th? This is a question, dude. I have people calling me. I didn't mean to call you, dude. You're Caden. I have people texting me every day. Lock, do I lock? Do I lock? Folks, let's get over to this here. This wasn't on the agenda today, but let's just go to the MBS Live. I'll be preparing for my live event here shortly. Here's what we're seeing in the markets right now. It is a great market for mortgage rates today. So here's what's going on in the markets. What we got this morning was an ADP payroll number. Thanks, Gaten. Hold on a second. I'll get to exactly what you're looking at right now. So this morning we got an ADP payroll number. Look, I don't know if you guys can see the number. Let me see if I can scooch it up there. This is a number that came in today. So here's the backdrop of some of this, just to bring you up to speed on some things. President Trump's been adamant. He's like, you need to cut rates before the markets really go bad. Why don't you cut rates before the employment market really plunges? Same thing like previously, before they started hiking rates. It's like, okay, Fed, you need to hike rates because inflation's starting to tick up. It was going from 2 to 3 to 4. When it hit about 5, they started increasing rates. So now what should they do? I've been a proponent of sitting on the sidelines, but some of these numbers are coming in. Let's go through them real quick. And this is why you're having a nice little rally in the markets. It's not because there's fantastic news out there. There's news that's saying, Fed, you got to do something here soon before we go off a cliff. So here's what really prompted today's market. This morning, ADP came out. Their reading, last reading was 62,000 new jobs were going to be created. They were expecting 115,000 in this report. It came in at 37,000. Now, a lot of people were making fun of me because they're like, Dan, it came in at a third of what was expected. Not 2/3 or whatever everybody was making. So they came in at a third is what was expected. They did a good job at the last reading. It was 67, and then it was revised to 60. That was down, but missing this was huge. And then you start going over to here, and some of the PMI servicing numbers and prices and so forth. These are encouraging as well. Okay, but tomorrow what we're going to get is right through here. We're going to get jobless claims and continued claims. And then on Friday, Friday, it's not giving it to us. Shoot. Friday is actually the unemployment rate. So that's going to fill in another piece of the gap. But what you're seeing right now is this market, let's pull it up. MBSs are up 42. If I'm you and I'm looking to lock, ride this thing as long as you can. And here's why. How locks work. And this is kind of on a subset. When you go in to lock your rate, you have to understand when to lock as well. So if there's market volatility, you might just want to grab what you can when you can, okay? But if you have time and the markets are stable, not like they are today, if you can wait up to like 21 days prior to closing to lock, you're going to get the best rate out there. And here's why. when you go out to extend an extended rate lock, let's say you're building a house, it's supposed to be done in about 2-3 months. You're like, okay, well, maybe I'll lock in. Well, if you need a 6 or a 3-month rate lock, that rate's going to be terrible. Because here's what happens is the bank has to basically hedge that money that they're going to use for you for that mortgage. So they kind of take down that money and they're going to have to pay interest on it. Okay, that's going to drive up the cost. So let me just put it in your perspective. Let's say today you can get a 7% rate on a 21-day lock. On a 30-day lock, it might be 7.125. On a 45-day lock, it might be 7.25. On a 60-day lock, it might be 7.375. On a 90-day lock, it might be 7.5. So the shorter the duration of time you need the lock for, well, the better the rate's going to be. But in volatile times like this, I'm like, it's hard to really determine what we do. So that's why I'm going to go to my website here for a second. We created this system for you guys, and this is for homeowners right now. If you're out there and you're trying to monitor this and trying to figure out, okay, when's a good time to refinance? Because in the past, if we go back, let's say 6 months, if you're familiar with my channel, you know that when this chart goes up, rates are coming down. Okay, back here, well, let's go back a year, because right in here, look at this. This was what was this? September of 2024. This is how high the prices went. This is when rates hit about 6.25, and the market was flooded with refinances. And then when this goes down, remember when this goes down, rates are coming up. Okay, so rates spiked from there. And this is right when the Federal Reserve cut rates. September, I think it was 15th, and then on the 16th and 17th, everything went to hell in a handbasket. So then rates spiked. And again, you kind of got to flip-flop this around. Okay, and then it went up here again. So now the people are like, okay, I'm going to jump back into the market, because we were pretty darn close. We were about 6, maybe 3.75, 6.5 at that time. And then rates turned and they spiked again. So how do you prepare for this if you're a homeowner? Well, we made a tool specifically for you. If you go down through here, and it's called the RateWatch, you can see it right through here. What you can do is you can put in your information on this, and we're working on the automation right now on how I'm going to contact you. But as soon as the rate hits where you're looking to do, I'll be reaching out to you and say, okay, let's lock in that rate. But we want to get you prepared. So I'm going to come out with a series of things that we're working on to get you prepared for the best time and getting the best opportunity when it comes to refinancing. So that's that out there for the homeowners. But if you're a home buyer, here's what we do. And I'll explain to you a caveat on what we do and the reason why I'm at this bank. Our bank, I work at a federal bank, so I'm a federally licensed mortgage loan officer. It's pretty cool, and I'm licensed in all 50 states as well as Puerto Rico. But the cooler thing is, and the reason why I'm here, we're set up with, I just had a meeting with our management this morning. We have 32 lenders that we're working with, and we're getting a lot of programs coming in down the pike. We're about a month away from home equity loans, first position, second positions, land loans, and even on home equity loans on investment properties. So we have a whole portfolio of products coming out shortly. And the reason why we do this is for you guys. Okay, we know when you're out there trying to buy that house or refinance, you're seeking, it's like, okay, I need to put my application in here. I got to get 3 to 4 different offers from different people, because then I got to check out and see who's the best and what the fees are. And so we have a system, we can do this for you. So, and that's the reason why we set up with 32 banks or 32 lenders, I'll put it that way. You putting in your application right through here, we're going to do the hard work for you. We're going to search, we're going to get you approved through Fannie Mae and Freddie Mac, and I'll explain that in another video. But the cool thing here is we're going to shop your loan over 30 different lenders. But if we lock you in, let's say you're building the house and you're not going to be done for 2-3 months, and you're like, you're adamant about locking in. Okay, let's lock in. Let's say if rates drop. So if they drop, maybe 0.25%, I can move you to a different lender that we're with. What happens is once you lock with your current bank, credit union, or whatever, you're done. You lock in and you are locked in. You can't call back and say, I made a mistake, rates went down, can you change me? It doesn't work that way. It's like buying a stock. You watch the stock, once you buy it, you own it, and there's nothing you can do about it. So that's what we do here. So let's get back to, I want to get back to your primary question. Let's get back to some of the other questions that we might have. But thank you so much for that question. Sorry, I won't dive in so much on these things. Everything sounds great. So that's what I would suggest you do. Keep watching my channel every day. I'll tell you guys, but don't fight the curve right now, because the curve or the charts right now, this is what's going on. But if you look at this chart right here, I do add in like 50 50-day moving averages and things like that. We are right there right now. So from here, that's why we're kind of stuck where we are today. It's going to take a little bit more to push these rates up a little bit, or the prices up a little bit higher, and bringing rates down a little bit further. But just watch my videos every day, but I would not lock in right now, because this is what's happening. And all these little bubbles up through here, these are lenders we use that every one of them just posted a rate reduction. So we get rate changes all throughout the day, and that's another area that a lot of people don't understand. They're like, okay, what's today's rate? Well, it's not today's rate. There was a rate all the way up to here with this one bank, and then they changed it. AMB wholesale. So it's 10:19 Eastern time. They actually reduced their rates. And then a lot of companies started following from there, and you'll see most of them, they have repriced for the day. So that's what we're seeing through there. So I would just wait and just see, wait till Friday, I guess. So that's my best suggestion. Does USDA GUS system have a certain credit score they've looking to get guaranteed approval? I don't know, to be honest with you. We use GUS. I'm assuming you would think it would be built in, but honestly, I'm not sure. GUS is, if you've done a lot of USDA loans, because the system GUS, and why I'm saying that is when you're working on a loan for a USDA borrower, there's a different system you have to use to get the loans approved. When you're working on a residential home, just like a conventional FHA or VA loan, you can use systems we call the systems of Fannie Mae and Freddie Mac. And you're starting to hear a lot about them in the headlines right now, because Pulte, the director of housing and urban development, I think he's the owner of Pulte Homes. He came in and he's, I don't know where I'm going with. We'll just skip that for now. Let's get to the rest of the questions. I'm rambling on you. I want to make sure all you guys are getting taken care of. Am I hog for waiting? Then will I be slaughtered? This must be Caden, you must be a long-time listener. Pigs get fat, hogs get slaughtered. I used to have T-shirts like that. Closing June 24th, currently in the underwriting process. It will be finalized tomorrow. New construction home using preferred lender. Fantastic. No, you're going to be good. The preferred lenders also, if they're giving you your credits and things like that, you'll be in a fantastic position. So great comment there. Pigs ahead. We'll be using you for refi. I appreciate that. So that's the report that we have. Let me see if there's any other things that we need to go over. Is there any other rules we need to look at? But the cool thing about this is you also got to see some of the verbiage in some of these 2009 websites and so forth. But hopefully you know or understand a little more now about how all these items will affect you if you're looking to buy a house, refinance a house. These are also good life lessons. If you're looking for a job, they're going to pull your credit. If you got shitty credit and you're delinquent on things, it might even reduce your chances of being hired. So I don't want to scare you there, but there's a lot of information you need to know, and hopefully we can provide those tools for you. So again, some of the tools that we want to offer for you guys today is creditscoresandmore.com. If you're out there and you're looking at a free credit score system, please use that. But if you really want to find your FICO score, if you use this, I think you get about a 20% discount. Different programs, if you're out there looking to see what kind of program you would qualify for, please reach out to us. I'd love to help. If you're looking to buy, refinance, or just kick the tires and see what the numbers look like, we'd love to hear from you. So go to therateupdate.com. We keep changing this on a daily and weekly basis. We just added our phone number up here. There was no phone number previously. If you want to ask me a question, we're trying to create a tab right here. Let's see if it's working yet. Where you can go in there, submit a question, and it'll actually come directly to me. I don't want to schedule a consultation. That's how we have it right now. But I'm trying to set that up where you can ask me a question through the system, and I can answer it to you. It's kind of like a chat, live chat, but it won't be live. So that's where we have a podcast. If you don't know about our podcast, check out our podcast channel here. It's growing and growing every day. I'm adding 2 or 3 things to that. And then we have videos right through here. But the one thing, if you are a homeowner right now and you want to get set up with that RateWatch tool, you can click here. What it's going to do is it's going to let me handle this for you. So what you'll do is you'll put in your information, tell me about who you are, what you are, and what mortgage you have now on your home, and what's the rate, and what rate are you looking for to refinance. And I'll get you prepared so when that rate hits there, we'll be able to take advantage of those rates so we don't miss them like we did back in the past. Where'd that system go? It's gone now. But when I was showing you the MBS chart, mortgage rates, they're coming back down. So don't miss this next little rally, because just the president saying a few words that just don't fit right, the whole market could change in a heartbeat. So that is my report for today, folks. I hope you learned something today. That's my whole goal of doing this. So if you need some assistance, like I said, if you're looking to buy or refinance, would love to help. But also check out credit scores and more and the other systems we have to help educate you guys.